So, good evening, friends. So, before we start the proceedings, I just have a small request for everybody. If we can put our respective phones on a silent mode. So, good evening, friends. It is my pleasure to welcome you all on this press conference as we announce Bandhan Bank's quarterly performance, financial results. We are delighted to have the members of the media, the top management team of the bank, and the leadership team of the bank who join us and who will share the key insights on our performance for this quarter. Most of you would have got the press release by now, and you would have gone through the headline numbers, and our leadership team will provide you in-depth look at our financial results, strategic initiatives, and other things. We are honored to have Mr. Parthavathan Sen Gupta, MD and CEO Bandhan Bank, who will be leading today's press conference. Along with him is Mr. Ratan Kumar Kesh on my left. On the left of Mr. Sen Gupta is Rajendra Kumar Babbar, our Executive Director and Chief Business Officer. And towards the extreme left is Mr. Rajiv Mantri, our Chief Financial Officer. MD sir will take you through the key highlights, and post that we will followed by Q&A. So over to you, sir.
A very good evening to you all. At the outset, let me welcome you to the Q1 press conference of Bandhan Bank for this financial year. I would like to highlight a few key points from our Q1 performances. Before we begin the quarterly performance review, I would like to highlight that Q1 FY26 is not aptly comparable to Q1 FY25, primarily due to the challenges we encountered in the micro segment following changes in the guardrails at the industry level. Despite these headwinds, we are performing reasonably well, and when benchmarked against the industry peers, especially those who are having microfinance books, our competitors, we have witnessed a sequential improvement in our financial performances. Further, as highlighted in our previous communications, we anticipate challenges in the EEB segment to persist till the second quarter of this year, albeit on an improving trajectory. In line with this outlook, our EEB portfolio has had a bearing on both our overall growth and profitability in Q1 financial year 26. That said, we remain cautiously optimistic. During the quarter, loan growth remained relatively subdued, largely due to the muted performances of the EEB book. However, non-EEB book continued to witness strong growth momentum. Profitability showed moderate improvement sequentially, and we remain encouraged by the sustained strength in our key operating metrics. We observed further increase in the proportion of secured loans in our overall portfolio, alongside a healthy rise in retail term deposits. These developments are contributing to a more diversified asset base and enhancing the stability and resilience of our balance sheet. In line with our guidance, we saw marginal improvement in slippages compared to the previous quarter, reflecting our continued emphasis on prudent asset quality management. Furthermore, our strong capital adequacy and comfortable liquidity position provide a robust foundation for a sustained growth and improved financial performance in the quarters ahead. As of June 30, 2025, the bank's gross advances stood at 1.34 lakh crores, registering a growth of 6.3% Y-on-Y. On the liability side, total deposits reached 1.55 lakh crores, reflecting a robust Y-o-Y growth of 16%, significantly outpacing the growth in advances and also better than the industry growth. This reflects our strategic focus on strengthening our granular liability franchise and ensuring a healthy balance sheet composition. Retail term deposits demonstrated strong momentum, growing by 34% Y-o-Y. This performance underscores the increasing trust and engagement of individual customers and highlights the effectiveness of our distribution network. CASA deposits now account for 27% of our total deposit base. The overall share of retail deposits remains steady at 68%, indicating a marked improvement in both the granularity and stability of our deposit base. We continue to execute our diversification strategy with steady progress. During the quarter, our secured book recorded a YOY growth of 29%, resulting in an improvement in the secured portfolio mix to 52% compared to 43% a year ago. From a business mix standpoint, our advances remain well diversified across various segments. The EEB group lending represented 25% of the total advances, SBAL at 14%, wholesale banking at 28%, housing represented 25%, and retail loans stood at 8% respectively. Maintaining asset quality remains a top priority. Credit costs saw moderate improvement sequentially, and we are committed to bringing them further down over the course of year. During the quarter, we undertook technical write-off amounting to 1,047 crore. Gross NPA stood at 5% and net NPA at 1.4%, while the provision coverage ratio, including the technical write-off, improved to 87.3% compared to 86.5% in the previous quarter. For Q1 FY26, net total income stood at 3,483 crore with an operating profit of 1,668 crore. This is quite improved position as from the March Q4 last financial year. The bank reported a PAT of rupees 372 crore for the quarter. On an annualized basis, ROAs stand at 0.8%, while ROE is at 6%, which witnessed a marginal improvement on sequential basis. Our capital position remains strong, including Q1 FY26 profit. The CAR, or the capital adequacy ratio, stands at 19.4%, and Tier 1 capital stands at 18.6%, providing adequate headroom to support future growth. Our branch network expanded to 1,750 branches with the addition of 35 new branches during the quarter. Furthermore, we launched specialized products tailored to target the customers which are in the elite society, which these products are Elite and Elite Plus savings bank account for the HNI segment. Looking ahead, our focus will continue to be on driving granular retail growth, advancing product innovation, and broadening our geographical footprint. Our bank is strategically diversifying its portfolio with a strong focus on retail lending, particularly in secured loan segment like housing loans, gold loans, auto loans, and commercial vehicles, and also construction equipment loans. Leveraging its extensive branch network and large customer base, the bank is enhancing existing customer relationships while expanding new partnerships. Emphasizing risk management, the bank integrates advanced analytics at every stage of the customer life cycle to ensure asset quality. Investments in digital platform, CRM, and data analytics are also improving, and customer experiences and operational efficiency are our focus areas. Overall, we remain committed to building long-term value through disciplined growth, strong risk management, and continued investment in our core capabilities. These strategic pillars continue to guide our actions as we navigate the current market environment. Thank you all.
Thank you, sir. Now we will just move to Q&A session. I would request anybody who has a question to raise your hands, introduce yourself for the benefit of a larger audience. We will get across the mic to you. If you can just introduce yourself for the benefit of the larger audience. Yeah.
Good evening, Mr. Shengupta. I'm Mithun from Hindu Business Line. So for the bank, sequentially the profit is up, but I mean on year-on-year basis, the profit is down. So what are the reasons?
Platform you're speaking, please.
You can, if you can raise your hand. Sir, on the second row.
Okay.
Can you hear me?
Yes,
Light,
I
thoda
can
dim
hear
kar
you,
do
but
light.
Because of the light, I could not focus.
Oh. Yeah.
Yeah.
So I was saying that sequentially, although the PAT is up, but year-on-year it is down. And what are the reasons for that? And second, that as we said, that technical write-off is 1,047 crore. So this is entirely from the, EEB book. So for that, what are the provision you made? Because I saw that year on year provision is also up.
Yeah. So as in the beginning of my speech, I have told that this quarter cannot be exactly comparable with the Q1 of the last financial year. See, last financial year, we had done exceptionally well, perhaps one of the best quarters, because the micro banking or the EB segment was highly optimistic. Suddenly, the dip started coming from August, and September, we could resist the dip and we could have posted a reasonably better profit, but not as like Q1 of last year. December and March, we had real challenges, as you all know, that we could post profit, but it was substantially lower than what we have posted in Q1 and Q2. Now, the factors that are attributable are, the first thing is that we all know the over-leveraging issues in the micro segment for that year. And there has been some also other factors beyond the control of the bank, which has adversely affected this segment. So the slippages were quite high, and we consciously took a decision to grow slow in this segment. So in the March quarter, we could post a reasonable profit of 318 crores. Our aim was that it should sequentially improve, and that's where we are successful. But let me tell you, to reach the level of Q1, we need to probably wait for another 1-2 quarters for that day, because unless this segment grows, unless the slippages in this segment comes down, and as you all know that there are many guardrails now imposed, and it is applicable for all lenders. So the business is still muted. The slippages are still very high. Of course, it is now the trend is looking it is coming down for that year, but that is the one reason this year it cannot be exactly compared with the profit of the last Q1 for that year. But sequentially, we have improved from 318 to 367. And let me also tell you, 318 consisted of almost 123 crores of amount which we have received from ECLGS, our guarantee. And because of that CGFMU, that guarantee schemes, because of that, we did not do an additional of 120 crores of provisions. This year, our balance sheet, there is no one-off income, and hence entirely thing has come from the operations of the bank for that year. This is the one reason. Your second question was on the write-off of 1,047 crores for that year, for which this year we have made an additional provision of 786 crores because we want to keep the PCR, the provision coverage ratio at 73 above. So 73.7% was our target, which we have kept it. So for that we have made some additional.
So maybe I can clarify that. So of the write-off that we had done, overall 1047 crores in this quarter, the additional provision we had to take because of write-off was 275 crores, right? And of which 275, of which 952 crores was relating to EEB, and the provision impact of that was 250 crores.
Correct.
And thank you for your answers. One additional question. So what about the what was the total slippages for Q1 FY26 and what was the figure for Q1 FY25?
What just
It's a fresh slippage.
slippage, huh? So let me give you the slippage was Q1 25. Again, I'm saying it was exceptionally well. It was 3%. But one good thing is that Q4 it went up to 5.6%, and now we are coming back. We are now at 4.8% this quarter. So sequentially, we are again improving. So in Q1, it was 3.3%. Q2, it went to 3.7% last year. Q3 was 5.2%, and Q4 was 5.6%. From there, again, the declining trend is happening, 4.8%. So we are expecting that if really the micro market also goes up for that year, probably we can reach Q1 by the end of Q4 this year.
What was that? I mean, in absolute term, what was the fresh slippages for Q1 FY26 and what was the
Q1 F125 is 891 crores, and Q4 Q1 FY26 is 1,553 crores. But let me give you the figure of Q4 FY25, that is last March, was 1,748 crores. So slippages have been contained. So 1,748 crores was in last Q4. It has come down to 1,553 crores. But of course, it is much higher than what was there in Q1. Last year, Q1 was an exceptional year for the bank.
So all these from EEB?
Mostly, this is out of which I can say of this 1,553 crores, 1,089 crores is from EEB.
Okay.
And balance is from the other segments.
Thank you. Thank you very much.
Do we have any other questions? Yeah.
Yeah, Mr. Sengupta, this is Pinak from the Telegraph newspaper. So just wanted to know, it's a two-part question. First is around how the guardrails have actually affected the microbook. And the second is of the 100 basis point transmission, how much you have already done and what has been the repricing like?
Okay. So let me tell you very frankly and candidly that there is an impact because of the guardrails. I think it has affected all the lenders, and we are also not an exception for that year, but it was necessary. It was necessary. And we all expected that in the first 3-4 months, there will be an impact, which over the period of time will actually get reduced. So we're expecting this, that Q3 onwards, probably this impact would not be there for that year. So this is thing I can tell you that the guardrails have impacted the business of EEB, but it was absolutely necessary for them. And the second question you have asked is?
I think repo rate, right?
So we have passed on. So almost 50% of my books are on floating interest rates, and we have passed on the effect to our borrowers. This year, the NIM this quarter has come down by 30 basis points. If you can look it at sequentially for that year, NIM has come down by 30 basis points because of this pass on of the interest rates. The 50 basis point now from 1st July, we have to pass it on. So this will be having definitely an impact of the NIM, but the plus point is that deposits rate also we have cut. So the immediate cut, almost 19 basis point impact from last Q4 to this Q1 we have witnessed. So the impact will be much more because, as you know, the fixed deposits are for a longer period of time. That impact will happen only on the date of maturity. But yes, a large extent of this, I think we can recover due to the decrease in cost of funds also.
So maybe I'll just clarify on the previous point. So repo rate of the 100 basis points, 25 basis points have been passed on in this quarter. 75 further has to be done in this quarter. 45% of our book is on repo right now.
So on the first point, guardrail is actually helping the industry. It is helping the borrower because the more and more discipline is getting created now. Otherwise, the borrower taking fourth loan, fifth loan. Now he knows that basically he can take up to this amount and only from a 3 lenders.
So it was necessary. I think it was necessary.
And sir, on the, given the situation, what would be your NIM guidance for the year?
No, so NIM, we are expecting NIM still a little bit of moderation will take place. So NIM wise, I can say percentage wise, definitely from what we have projected, another definitely 20 to 30 basis point moderation will take place for the day. But with the increased volume in business, the quantum of the profit definitely will try to increase.
I think 3 or 4 factors to weigh. One is really about the slippages. As the slippages become more controlled, we should have some sort of benefit on that. The second is, the repo rate I've already mentioned, what kind of impact will come through. I think Sir has already taken actions in terms of reducing cost of funds. We reduced our savings rate and also term deposit rates. Savings impact came through immediately. We saw 19 basis points reduction in cost of deposits. And the term deposit impact will come through in Q3 and Q4 largely. So those are 3 or 4 factors to look at.
Thank you, Pinak. If we have any further questions from the media side? Yeah, please.
Atodi from Economic Times. Quite a few queries actually. Number one is, do you have MCLR? What is the percentage of your loans are linked to MCLR? This is number one. And whether you would like to increase the MCR share of MCR books. That is number one. I'll ask later on.
Okay. So MCLR, I don't have much. I have got only 5,300 crores around. in my MCLR book. So in fact, my MCLR reduction is much more than the repo rate. It has reduced by 200 basis points that we have passed on to our borrowers for the. But going, you see, look at our composition, almost 50% of our books still are having in the fixed rate for that year. And another 50% through some various floating rates like MCLR, repo and other EBRs for that year. So going forward, the MCLR book will almost remain at the this level only.
And,
But yes, some commercial banking loans which are now repo based, like the wholesale and that I would say the high valued credit. So we are examining that. Okay, can we bring the MCLR in place of EBR for that year? That also, of course, we are examining.
Thank you. The second query is, as you said, that almost 50% of your loans, in fact, maybe a little over 50%, is fixed rates. So whether you have passed on the higher credit cost to a borrower, that means whether you have raised the rates on your microfinance book?
No. We have not raised the rates on microfinance for that year. So it is remaining the same. So in fact, if the slippages do come around for that year are controlled, because now the major impediment is that the slippages in microfinance are still high and still in double digit. So if I can control it and make it half for that year, we can also think of a moderation.
Okay. And what is the range of the rate at this point in microfinance?
It is 22%.
I think our rate is roughly around 22%.
22 to 22.5, something.
Yeah. On an sort of effective basis, I think come around 20% if you net off for the slippage impact. Yeah.
Okay. And you have already
That
said
is the maximum rate. But if you consider all the products, some are even at lower rate.
you have already said, but just for clarification, what is the slippages in Q1 FY25? That means last year?
So total slippages last year, Q1 25 was 891 crores, of which EB was 543.
Yes.
Last quarter was 1748 overall, and this quarter is 1553 overall. EB last quarter was 1349, and this quarter is 1089.
Okay. And what is the breakup of your different verticals? That means EB, housing, and
This advances breakup?
Advances breakup.
Okay. So I can tell you that EB now, we are having 52,812 crores. Housing, we are having 32,664. Retail, we are having 11,098. And wholesale, we are having 32,781 plus 4,036 you can add, so it can be 36,781. And let me tell you that the share of EB has come down from 50%, 49, almost 50% June 24 to 39.6. The housing finance share has gone up from 22.6% to 24.5. The retail assets have gone up from 5% to 8.3%. Wholesale book has gone up from 18% to 24.6%.
Atmadeep, the investor deck actually has full slide on this. Yeah.
Thank you.
Thank you, Atmadeep. We have a question from here, if you can just have the mic. So if you can introduce yourself, please.
Yeah.
Just, okay.
I am Abhishek from Informis Newswire. Wanted to ask you that your share, if I look at your loan book, the EB and SBL is going down. So is there any particular target you have in mind that you are targeting to reach?
No, so
to?
last year when suddenly the slippages were getting high, almost the entire industry was affected. In fact, Bandhan has done much better than the industry. The industry slippages were much higher, but we consciously decided to go slow on this segment. So that trend is there. But again, I am telling you that while we are very selective, the guardrails, as we have asked for, someone has told for the day, the guardrails have also impacted during the first quarter. Because, and we knew that this impact will be there. So almost 3-4 months till the industry and the borrowers get accustomed to the new guardrails, because what my ED has also told, that now they are aware that they cannot take more than 2 lakhs loan and not form 3 lenders. So this was necessary. So these have actually impacted, and that's why my also loan book has degrown for the day. And apart from this, definitely there was a conscious decision as regarding the increase in this segment because of the high slippages.
How do you see it in the? For
So
the
we are expecting, like everyone in the market is expecting that Q2 onwards, definitely the things will go up, Q3 onwards. And if you look at my own delinquency book, so one very good comfort is coming, my SMA2 position is coming down. So that is a very good comfort we have done it. But we have also done some hygienic changes in our EEB segment. As you all know that earlier there was no recovery on holiday period, but now keeping in line with the IRAC circular and RBI guidelines, we have introduced that. So that is why a little bit increase in the SMA0 book is there. But these are all recoverable. So this remains in the SMA0 because of the holidays. And next quarter also because of the puja, almost Bengal where I have got the maximum number, and Assam and the eastern part where there will be block holidays. So there will be an increase in SMA0 that we are already anticipating. But these are all recoverable. So collection percentage is almost 99% we have reached.
Thank you. Do we have any other questions from the media?
Yeah.
Yeah.
Mithun again. So one thing that of your total provision, so one part is for the provisioning for the write-off, and what about the provisioning for NPA for this quarter?
Provision figures you're having, details?
Yeah. You're talking about the balance sheet amount or the in what we have taken during the quarter?
What you taken during the quarter?
During the quarter, okay. So total provisions that we've taken during the quarter is 1,147 crores. This includes both the NPA provision as well as the standard asset provision. So this is the total credit cost, 1,147. So this includes the impact of all kinds of provision, including the write-off related and the normal NPA provision.
So of 1147, so just a minute. 275, as you said, the
Correct.
provision for the write-off, no?
Correct, correct,
Yeah,
absolutely.
Yeah.
Yes, 275 for the write-off.
Yeah.
Good evening.
Thank you, Mithun.
Good evening, everyone. I'm Rajiv Ghosh from Dainik Bhaskar. Just wanted to understand that how is bank performing at tier 2 and tier 3 cities, specifically the Hindi-speaking markets where the disposable income has gone up in recent times.
Yeah. So let me tell you that our strength belongs to this city. Bandhan has been more or less formed, giving more emphasis on the rural and semi-urban areas. And we have opened almost 35 branches during the last quarter, of which, and 47 branches, I can say, last 2 quarters. And of which, apart from 2 branches, I think all are on, in the majority of them are been opened in these 2 cities. So definitely, there is a lot of positivity. And as you can see from our statistics for the year, that the growth in the deposits that has come, despite lowering our interest rates, is because of the contribution of these branches in these 2 segments.
Thank you, sir.
Thank you. We can take one last question if we have any. I think since we have no questions, I think thank you very much, everybody, for joining us here for this press conference. I'm sure if you have any further questions, you can please reach out to us. The senior management is here. I invite you, everybody, to join us for the high tea. Thank you very much.